Let's get a look at your money right now on Good Morning Quad Cities. But first, let's get a weekly stock market recap. The S&P 500 up more than 140 points. The NASDAQ up more than 200 points. And the Dow Jones Industrial Average up more than 1,700 points. That all sounds like great news. And on Thursday, the Department of Commerce reported that our nation's economy grew at an annualized rate of 2.6% in the third quarter. But despite that, many economists still forecasting a recession at some point within the next 12 months. But are all recessions created equal? So joining us to answer that question right now is our financial expert, Mark Gravicheski from the Quad Cities Investment Group. Good morning, Mark.
Good morning to you, and a very happy Halloween to you and everyone back at the studio.
Yes, you as well. But aside from knowing what the economic report shows, that the economy grew in the last quarter, what does it actually mean for the average person?
Well, Thursday's GDP report by the Department of Commerce, it was an okay report, David. It wasn't bad. It wasn't great. In the third quarter, the economy grew at a very respectable annualized rate of 2.6%. And this effectively ended that technical recession we got, back in the first and second quarter of this year. And remember, a technical recession is defined as 2 consecutive quarters of negative economic growth. But that technical recession in the first and second quarter, David, it wasn't severe enough to be declared an official recession. But look, whether you call it a technical recession, but not an official recession, I think right now you're missing the bigger picture. Wall Street, is the main thing on Wall Street's mind right now. Are those economic storm clouds gathering on the horizon, where the overwhelming consensus is we'll likely get a much more severe recession in the second half of next year.
Okay, but what is the difference between a mild and a severe recession, and what have some of the most recent recessions been?
A great example, David, of a mild recession was in the first and second quarter of this year. We had a very slight contraction in economic growth, but the key factor was, the labor market, consumer spending, industrial production, and many other facets of the U.S. economy were still quite strong. And that's why that technical recession of the first 2 quarters was not officially declared a recession. But then compare that to the first and second quarter of 2020, just 2 years ago. Yes, it was also short term, but it was much more severe as governments around the world shut down their economies and essentially closed their borders. We saw a much more deep and expansive impact across the economy, especially in that U.S. labor market, David. If you remember, in a time span of just 2 months, the U.S. labor market, lost about 22 million jobs. And also back in 2008, 2009, we had a severe and longer lasting recession caused by the subprime mortgage crisis, which eventually helped trigger the global financial crisis. So, recessions do occur, but obviously when they do, we hope they're short, they're mild, which, limits the impact to consumers and businesses.
Okay, and how can Wall Street essentially predict that a recession will happen? And how can we tame our anxiety really around a possibility of one?
Surprisingly, it's not so much of a crystal ball, but it really, when you think about it, David, it ties back to these very aggressive interest rate hikes we've been getting by the Federal Reserve to help get this inflation under control. Remember, the Fed has been aggressively raising interest rates. The problem, though, David, is that these higher interest rates, they essentially take a very punishing toll on consumers, on businesses, and the economy. And it takes about 6 to 9 months for all of these interest rate hikes to essentially filter their way through the economy. And that's why that recession is being expected in the second half of next year, essentially 6 to 9 months from the end of this year. Now, no one can say with absolute certainty a recession is going to happen or or how severe or long lasting it might be. But do your best to financially prepare yourself for the worst. I know it's extremely difficult to save money with this very high inflation we're seeing, but try and build up some type of cash reserve in case you do lose your job. Kind of the better you prepare yourself in advance for any potential recession, hopefully the less anxiety all this uncertainty creates.
All right, great tips. Thank you, Mark, so much. And we will see you next Monday.
All right. Enjoy the rest of your week, David. Take care.
You as well.